Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
I want to talk a bit about the emerging credit scenario in India. What I mean by this is there are fears of a worsening credit quality, that is the ability of corporates to service their debt. If you just look at the non-performing assets or NPAs in the banking system, this NPA ratio has risen close to a 10-year high. On a broader economy, there has been a deterioration in credit quality. At the same time, and quite interestingly or quite contrarily, the spread of lower rated companies has in fact decreased over the last 3 years. For example, AA rated corporates are today able to borrow at a spread of about 100 basis points over corresponding government securities compared to about 200 basis points 3 years ago. That is to say, the compensation for taking credit risk has decreased even as the credit risk itself has increased. The same can be observed, in fact, in further lower rated papers. Papers rated A, which is one category lower than AA, are now placed at 200 basis points over government securities, and the same papers used to be 300 or more a couple of years ago. Note that A rated papers are today where AA papers used to be a few years ago, even though A rated papers are higher risk than AA securities. What does this mean for markets? This means that you are not getting adequately compensated for credit risk that has been taken. Indeed, complicating this is the fact that the credit industry in India has dramatically increased in size in the recent past. The total size of credit mutual funds has increased by a factor of 2, that is, they have doubled in size in the last 2 years to nearly 70,000 crores. Within this, the proportion of securities rated A or lower has gone up sharply in the last couple of years, from just about a quarter total assets to over half of all assets. So you have a very interesting combination of worsening credit quality, lower spreads, and larger size. How does this pan out? Firstly, even with the rise in NPAs, it is extremely unlikely that we will have a widespread credit default situation in India. Unlike 2008-2009, there is no external liquidity issue, which means portfolios having a high share of AAA and government securities continue to be very liquid in today's scenario. Of course, funds which are heavily exposed to the corporate bond side, and especially lower rated corporate bond side, will face liquidity issues should they see outflows. What we see, therefore, as key risks in the sector are twofold. One, the lack of compensation or lack of yield for the risk taken, and two, the lack of liquidity in the underlying market. At Axis Mutual Fund, we therefore have a very conservative stance towards credit. Firstly, we do not have any credit funds. Most of our funds have 75% or more in AAA and government securities. Most of our funds also have very strict limits on what we can invest in lower rated papers. To illustrate, most of our funds have exposure limits of 2% per issuer, AA minus and below. What this means is you get an adequate diversification should there be a downgrade in any one issuer. So it is not to say that you cannot participate in credit, but the right way to look at credit is to have an asset allocation approach. Well, let's take an example to illustrate this. If you have a top-notch bank and nearby you have more poor rated bank or a cooperative bank or an NBFC, which offers you perhaps a 1% or 2% higher yield, would you move all of your deposits from the better rated bank to the poor rated cooperative bank or NBFC? I would think not. You probably take an asset allocation approach and perhaps take a smaller allocation to the higher risk entity. In much the same way, we must approach credit in mutual funds. That is to say, have a larger share in safe assets and a much smaller share perhaps in higher yielding, higher risk securities. That sums up Axis Mutual Fund's philosophy on credit. With all this fear of credit, there is of course the worry that all mutual funds are going to get into difficulties. This is not the case. We have to differentiate between those funds which are substantially invested in AAA, government securities and money market, which are safe, and those funds which are substantially invested in lower rated paper. In today's scenario, both credit difficulties and liquidity issues are found in lower rated paper. Staying with high quality is a way to protect your investments at this stage.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund Family.